Welcome back to my channel, Balance Sheets Matter. Today we're going to be looking at Costco and do a stock analysis on Costco. But before we get into the analysis, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos. So if you want to get good ideas on potential stocks to buy or value traps to avoid, make sure to subscribe to my channel. And if you do want me to look at a stock, make sure to leave it in the comments below because I do frequently cover stocks that are from subscriber requests. So let's get into the Costco stock analysis. So I first like to look at a little bit of these top level things on Guru Focus. Obviously, like to take a quick glance at the Guru Focus value band here, saying it's about fairly valued. We'll see if that's going to be accurate or not. The stock is quite expensive right now at over a 40 PE with a forward PE of only 37.31. So still fairly expensive. We're going to look at the financials and see if this is justified or not. They also do pay a little bit of a dividend of 0.69%, but a fairly low payout ratio of 0.27. So we're going to look at the financials now and see why Costco is so relatively expensive with such a high PE. So we can see on the right here, this is the green line is the revenue growth trend with analyst projections as well. And as you can see, they've been growing at a very steady trend. Over the last 10 years, that's been about 8.8% per year with EPS quite outpacing that at 12.9%. So I'm going to explain why this is, and this will get a lot into the valuation of Costco and probably to help you decide if you want to buy or sell the stock potentially. So we can also look at the return on invested capital. The return on invested capital has been getting better over the years. It is higher than their weighted average cost of capital regardless. So that does say they are very good at reinvesting their money into the company and producing growth with it, which we can already see basically by that top line revenue growth. They keep happening. They keep opening more stores and they do keep growing. So just because in a lot of other retailers, I've brought this up when it was an issue, but if you look at the inventory, the revenue, a lot of inventory, like retailers that did start having inventory issues, it did stock up and they did have to slash prices, you saw this ratio go a lot higher. But you'll see Costco here, it's been steady, very steady over all the years at 0.07. So you can see Costco has not encountered these same similar type supply chain issues or inventory overloads that a lot of other retailers have experienced. So we look at basically the income statement here. You can see, as we saw with before, revenue has been growing quite strong, and even like in these last years, it's actually quite impressive. 2018, 141 billion to 242 billion in the last current year, and their gross margins being fairly stable. We're at a little bit of a lower point right now, and that may be because of a little bit of supply chain, the cost of goods, things are more expensive, and you can see their gross margin has squeezed down a little bit. It's about 12.26. In 22, when things were even worse, it was 12.15, and this was in comparison to previous years when they're around 13 and maybe just a little bit below that. But in the last basically about 15 years, this is about the worst gross margin they've had. But on the other side, the more better side, they have been raising their operating margin. So they've been their selling and general admin expenses has not been growing at the same pace basically as the revenue. So this has been adding more to their bottom line, which is a very good sign. But it's also probably why we've been seeing this big multiple expansion and why the EPS has been growing as well. Because while their revenue is growing at 8%, their EPS is able to grow faster since their operating margin is growing, at a faster rate than basically the revenue. And as you can see back in the day here, they're around say 12.5 to maybe at the highest about 3. And now they've grown, they peaked closer to 3.5 and are at 3.35 in the last year right now. So that's been increasing quite a bit. Interest income and interest expense, they've been making a lot of interest income, probably with some cash sitting on their balance sheet. They've been earning in treasuries, and that's now higher than their interest expense, which is really, really low. So they have a really strong balance sheet because we have basically over $8 billion in income here, and they're only paying $160 million in interest expense. So that's a really good balance sheet, a really good interest ratio. Costco has not loaded up with a lot of debt at all. And you can see as we go down further, also what helped them is tax cuts did help them. Going from paying 35% taxes down to 25% taxes does significantly help you, though they are global corporations, so they do have different locations all around the world, and they are paying different taxes to different governments, which will make this fluctuate over time, as you've seen. But that's basically left them with a very good net margin that's also been increasing. So you can see this has been a lot of the reason why Costco's probably had this very, very big multiple expansion here, is because now their net margin is at 2.6%. And if we look at before, it was as low as about 1.64%. So this really has driven a lot of this EPS growth at the end of the day. They also, for the shares outstanding, they actually really don't buy back a lot of shares. You can see basically 15 years ago, 444 million shares. They're still sitting at the same share count today of about 444 million. Does fluctuate up and down a little bit, probably a little bit of stock-based compensation, and they probably buy back a little bit. But overall, Costco seems to just reinvest their money into their core business of opening new Costco wholesale stores. So now let's go down to the balance sheet and check that out. You can basically see current assets sitting at about almost $36 billion. And yeah, we saw that big interest income they were getting. And you can basically see cash and cash equivalents here, almost at $15 billion. So that's pretty strong. And let's look at their total current liabilities. Total current liabilities, it's about $33 billion. So they have a little bit more current assets than their current liabilities, which is a good overall current ratio. And even though they basically do have about a current ratio of only barely just over 1, because they are able to basically, I guess, sit on this extra cash, they are able to earn extra interest investing in treasuries or receiving interest from money market funds. So that's a big plus when you don't have to pay your suppliers and you just get the right away at least, and then you just get to sit on the cash and collect interest on it. So that's one benefit Costco's benefited basically during with these higher interest rate environments here. We look at their total assets sitting almost at $69 billion. Basically no intangibles, no goodwill. That's kind of like, a good sign. Although, obviously there's a lot of land, building improvements, machinery. This is basically their Costco stores. There's a lot of equipment and other, racks and other stuff they have inside that they do have to invest money in all these stores. And then their total current, or no, not total current liabilities, but their total liabilities is only just under $44 billion, leaving them kind of real tangible equity of about $25 billion. Although this is all kind of really invested in their stores, in their infrastructure that they have. So, this isn't actually just free cash because we saw with their current ratio, balanced itself out. But still, overall, quite a strong balance sheet. Costco sitting in a very strong position. And you can see their total long-term debt is just over $5 billion. It's very low. They've actually paid it down over the last few years. In 2020, they had 7.5, and now they're only down to 5.3. So overall, very, very healthy balance sheet. They're sitting really good. They're really have opportunities if they want to acquisitions or more expansions. So let's take a look at their cash flow statement. First of all, it's always getting a good idea of what their cash flow for depreciation is compared to the purchase of plant, property, and equipment. So we can see, compared to the cash flow from depreciation, they're depreciating at a much slower rate than they're actually having to purchase their plant, property, and equipment. So a lot of this number being higher in the purchase of plant, property, and equipment will be basically because they are opening new stores, but this discrepancy between these levels is pretty big. So it kind of looks like, to me, I would say, a lot of what we're seeing, those assets on the balance sheet, may not actually be there because they're depreciating them at a slower rate than they're actually having to replace them. Or at least that's what that's suggesting. And it looks like they have done one acquisition in 2020 of just over $1 billion. So this may be a potential expansion for Costco to start getting more into the future. Maybe they want to start buying other different brands or, another chain, or who knows exactly what they're going to do. But this is a potential business growth opportunity I'm seeing potentially for Costco in the future because there's a limited amount of stores they can open. I'm a Costco member myself. I like shopping at Costco, but is it really going to help having more Costco stores in my area when I already have several that are accessible? I wouldn't say though. So even though they always seem quite busy all the time anyways. And then we can also see there is some stock-based compensation going, as I was saying earlier, and they're obviously just using a little bit of share buybacks to counterbalance this out here. So we go down a little bit further, and what do we see? You can see basically free cash flow has been quite positive over the years, although they pay a little bit of this dividend, but mostly just reinvesting back into the business. And then you can see repurchase of stock, mostly just offsetting the stock they're basically issuing for stock-based compensation. So don't get fooled by the free cash flow, because a lot of people look at free cash flow and they don't factor in the stock-based compensation because they're compensating their employees and management with stock, and then they're rebuying it back out. So I think EPS is a pretty good factor to look in, but even then, I would maybe consider it a little bit lower since they do seem to be having to replace purchase of plant, property, and equipment at a little bit faster rate than they are basically depreciating it, even factoring in for their growth. So let's kind of get into some relative evaluation here in the interactive chart. So let's bring that up. So let's pop up the revenue with estimate to get an idea of what analysts are thinking, and the EPS with estimate. So you can see they're expecting it to basically continue growing at this, consistent pace over the years, although when you growing, say, 20 billion in sales per year, because your sales are higher and higher every year, that's a smaller and smaller growth percentage. So we should be seeing some deceleration in growth for Costco. But really what we need to look at on their front here is their margins, because that's what really matters for Costco, and where they've seen a lot of their growth, as I mentioned before, was the margins. And we're going to see realistically if these can expand more or where these could potentially be headed to in the future. So basically we're looking at the gross margin here, and let's go to a 30-year chart here. Because economic times a little bit tough, it is a little bit on the lower side right now, so we probably should expect this to come back up. But you can see basically since, even before 2000 here, it's been kind of trending in this between kind of 12 and in the high 13 percentages. So I wouldn't be expecting either in any long-term scenario going forward for Costco to see a real big deviation from this. They're probably going to revert back to the mid 12s in their gross margin, but we shouldn't expect to really see this decline. But we shouldn't be expecting this to increase either, because they do their whole business is offering bulk low prices. So if they really started raising prices, that really wouldn't make much sense for their business model. So I would expect this to kind of like revert back, maybe raise a little bit back up in these mid 12s, but wouldn't expect to see it going any higher. Now let's look at the operating margin, because this is quite important, and this kind of will show you where a lot of this growth has come from. So let's get rid of the gross margin and take a look at the operating margin. And you can see before, the operating margin here, well, I guess like way back before 2000, it was a little bit higher in these same ranges it was before. This was about the peak they had before 2000, and they've managed to get themselves up to that peak efficiency before, and it was a little bit lower. But this is the one thing, this has been what's driving that accelerated EPS growth, and I frankly don't think they're going to be able to keep up accelerating this operating margin really any higher than it currently is. If their gross margin is not getting better, there is a certain amount of overhead they have to do. There's employees they have to have in the stores. They really can't reduce those anymore. There's only so many efficiencies they can have, and I think it may be, considering they're at a high right now, seeing any increase above this may be very, very, very unlikely. So that's going to really put a damper on Costco's growth, because if their operating margin is not growing anymore, their EPS is only going to be growing in line with basically the revenue growth, which is probably going to be sub 8% going forward. So I'm thinking that 40 PE may be a little high. And we can also look at the net margin here, because the net margin at the end of the day is what really matters, because that's how much money you're taking home. And this has grown because it had both the tailwinds, I should say, of get those more efficiencies and the tax cuts. So even comparing to 2000, because the taxes were lower and everything else, they were able to drive this up quite a bit, about 2.6%. You can see before at the low, maybe about 1.5%. Their mean was 1.8%. So now let's take a look at the price to sales ratio. They get a relative valuation of the company. And this will kind of give you a little bit more idea of what I see about Costco and its valuation. So right now the price to sales ratio is about 1. But you look at what it was before, all in these times past here, they were trading maybe on the high side at about a 0.49 and the low side even lower. So when we're looking at a high side of 0.49, even a 1 right now, which is kind of in this mid-range they've been in for the last while, is double what it previously was. And just think of this, that what the net margin was. The net margin has at 2.6%, but has that doubled? That has not doubled basically. So I think Costco is a little bit on the pricey side right now. And I think this basically, this price to sales ratio and therefore their valuation is probably going to start contracting when we start seeing that deceleration basically in net margin and operating margins growth, which I think is happening now. So does that mean doom and gloom for Costco? No, I don't necessarily think they're going to have a big crash or anything. They're kind of a defensive company. You can see during this whole time there, and let's just go a little bit shorter term chart here and actually bring up the price, not just the price to sales. So we'll bring up the price here, although it does track the price to sales pretty well. Basically in 2022, they did quite well compared to the market, and they've basically consolidating sideways and chopping. And I think there's a good chance that could continue. They could keep pushing higher, but with everything happening, I don't see really any catalysts for more basically operating margin growth. They could get a short-term little boost from the gross margins going back up again, but I don't think basically the operating margins, they're likely going to get much more efficient than when they actually are. So when that plateaus, I would probably expect to see Costco contract a little bit in their valuation. Maybe that's just going to mean they're going to go sideways in price and not going anywhere, since the company's overall very good, has very good fundamentals. But I guess that's, again, just what I'm trying to drive at. The main factor for Costco, which is headwind, is when those operating margins and those net margins basically stop expanding. We're probably going to see a contraction in the multiples, because if we actually look at the price of sales, just not to beat a dead horse here, but let's compare this to the net margin, and you're going to see these actually align quite up together, because it's kind of the market's factoring Costco for that factor faster growth. So basically the price to sales went up as the net margins went up. So once the net margins basically stop increasing, we'll probably see a contraction in Costco's multiples, price to sales, and come down to a more realistic valuation. So, I'm not looking at Costco here. I owned it before and it was a little bit cheaper. I sold it, not looking at getting back into it again, but, could keep going higher. But either way, I hope you like this analysis. I hope it gave you some insights. Remember to like the video, subscribe to my channel, and I'll see you in the next stock analysis.